Question 1. Which of the following is a key consideration when underwriting a disability insurance policy for a self-employed individual in Georgia? A. The individual's pre-existing medical conditions are the sole determining factor in eligibility. B. Non-medical factors such as the individual's financial need and occupation play a significant role in underwriting. C. The individual must have an employer-sponsored group disability plan to qualify for coverage. D. Only the income of the individual is used to determine the monthly benefit amount. Answer: B. Non-medical factors such as the individual's financial need and occupation play a significant role in underwriting. Explanation: when underwriting disability insurance for self-employed individuals, both medical and non-medical factors are considered. Non-medical factors, such as occupation, which may involve higher risk and financial need, are critical in determining eligibility and policy terms. Pre-existing conditions are also evaluated, but they are not the sole factor. Employer-sponsored plans are not applicable to self-employed individuals, and the income of the individual is used to calculate benefits but does not solely determine eligibility or underwriting decisions. Question 2. What is the primary purpose of the elimination period of ECA disability insurance policy? A. It is the period during which the insured must prove their disability to the insurance company. B. It defines the maximum amount of time an individual can receive disability benefits. C. It is the waiting period before disability benefits begin after a claim is filed. D. It refers to the period during which the insured is not allowed to receive benefits if they are still employed. Answer: C. It is the waiting period before disability benefits begin after a claim is filed. Explanation: the elimination period is a waiting period that starts after a disability claim is filed and before benefits are paid. It serves as a deductible period where no benefits are provided, and the insured must endure this waiting period before they begin receiving payouts. This period typically ranges from 30 to 180 days, depending on the policy terms. The elimination period is designed to reduce the frequency of small claims and to encourage insured individuals to use other means of income during short-term disabilities. Question 3. Scenario-based. Mr. Thompson has been covered under a long-term disability policy for the last 5 years, paying premiums regularly. Recently, he was diagnosed with a medical condition that will prevent him from working for more than 6 months. Mr. Thompson's policy has a 90-day elimination period. He files a claim for his condition after being unable to work for 45 days. Which of the following actions should Mr. Thompson take next? A. Mr. Thompson should immediately submit medical records and employment history to the insurer, as benefits are payable after the 45th day of disability. B. Mr. Thompson must wait for an additional 45 days before submitting the claim, as he has not yet met the elimination period. C. Mr. Thompson is not eligible for benefits since his medical condition occurred after the policy was issued. D. Mr. Thompson should contact a legal advisor before submitting the claim, as the condition is considered a pre-existing condition. Answer: B. Mr. Thompson must wait for an additional 45 days before submitting the claim, as he has not yet met the elimination period. Explanation: in this scenario, Mr. Thompson's policy includes a 90-day elimination period, meaning that he is not eligible for benefits until after 90 days of being disabled. Although he has been unable to work for 45 days, he must wait for the full 90-day elimination period to pass before he can file a claim for benefits. The elimination period is a set waiting period before the insurance company starts to provide coverage, and Mr. Thompson's disability benefits are contingent upon completing this waiting period. Therefore, option B is correct, as he must wait for the full 90 days to be eligible for benefits. Question 4. Which of the following is typically a feature of short-term disability insurance policies compared to long-term disability policies? A. Short-term disability policies have a longer benefit period than long-term disability policies. B. Short-term disability policies generally provide lower monthly benefit amounts than long-term disability policies. C. Short-term disability policies typically have a longer elimination period than long-term disability policies. D. Short-term disability policies are often available to self-employed individuals, while long-term disability policies are not. Answer: B. Short-term disability policies generally provide lower monthly benefit amounts than long-term disability policies. Explanation: short-term disability insurance typically provides lower monthly benefit amounts compared to long-term disability policies. While both types of policies may have a similar structure in terms of coverage, short-term disability insurance is designed to provide temporary income replacement. often with a benefit period of a few weeks to a few months. Long-term disability policies provide income replacement for a longer duration, often years, and can offer higher monthly benefit amounts due to the extended coverage period. Question 5. Which of the following is not a valid exclusion in a disability insurance policy? A. Self-inflicted injuries. B. Disabilities caused by drug or alcohol abuse. C. Disabilities caused by participation in criminal activities. D. Disabilities resulting from pregnancy and childbirth. Answer: D. Disabilities resulting from pregnancy and childbirth. Explanation: disability insurance policies typically exclude coverage for self-inflicted injuries, disabilities caused by drug or alcohol abuse, and injuries resulting from criminal activities, as these are considered avoidable risks or behaviors. However, disabilities resulting from pregnancy and childbirth are generally not excluded under most disability insurance policies. In fact, many policies provide coverage for maternity-related disabilities, though there may be waiting periods or limitations depending on the policy. Question 6. Scenario-based. Mrs. Harris, a small business owner, has a disability insurance policy that covers her income in the event of a long-term disability. She is currently recovering from a knee surgery that is expected to keep her out of work for 10 weeks. Her policy includes a 60-day elimination period. Mrs. Harris has been unable to work for 30 days so far. How should she proceed with her claim? A. Mrs. Harris should file her claim immediately, as she is already eligible for benefits after 30 days. B. Mrs. Harris must wait another 30 days to complete the 60-day elimination period before filing her claim. C. Mrs. Harris should cancel her policy because her surgery is considered a pre-existing condition. D. Mrs. Harris must contact her insurance company to request a waiver for the elimination period. Answer: B. Mrs. Harris must wait another 30 days to complete the 60-day elimination period before filing her claim. Explanation: the 60-day elimination period means that Mrs. Harris must wait for 60 days from the start of her disability before she can file a claim for benefits. Since she has already been out of work for 30 days, she needs to wait for another 30 days to meet the elimination period requirement. The elimination period is essentially a waiting period before the benefits are paid, and filing a claim before the period is over would likely result in a denial. Question 7. Which of the following best describes the impact of an elimination period on disability insurance premiums? A. A shorter elimination period results in higher premiums because benefits are paid out sooner. B. A shorter elimination period results in lower premiums because the insurer pays benefits sooner. C. A longer elimination period results in higher premiums because the insured is more likely to file a claim. D. A longer elimination period results in lower premiums because the insurer pays benefits later. Answer: D. A longer elimination period results in lower premiums because the insurer pays benefits later. Explanation: a longer elimination period means the insured must wait longer before benefits are paid. Since the insurance company is not responsible for paying out benefits during this period, the risk to the insurer is lower, leading to lower premiums. Conversely, a shorter elimination period means the insurer will pay benefits sooner, increasing the risk and resulting in higher premiums. Question 8. Which of the following best describes the relationship between Social Security Disability Insurance (SSDI) and private disability insurance? A. SSDI benefits are automatically coordinated with private disability benefits, reducing the amount of private disability coverage paid. B. SSDI benefits are provided on top of private disability benefits with no impact on the amount of the private benefit. C. SSDI benefits are only available to individuals who have private disability insurance coverage. D. Private disability insurance policies typically reduce the amount of benefits based on the SSDI payment amount. Answer A. SSDI benefits are automatically coordinated with private disability benefits, reducing the amount of private disability coverage paid. Explanation: when an individual is receiving both SSDI benefits and private disability insurance benefits, most private insurance policies include a provision known as a coordination of benefits. This provision reduces the private disability benefit if the individual is also receiving SSDI benefits. The purpose of coordination of benefits is to prevent the insured from receiving more than 100% of their pre-disability income. SSDI benefits are often considered a primary source of income, and the private insurance benefit is adjusted accordingly. Question 9. In Georgia, how does workers' compensation disability coverage affect the eligibility for private disability insurance benefits? A. Workers' compensation benefits automatically replace private disability insurance benefits, making the individual ineligible for private disability payments. B. Workers' compensation benefits are coordinated with private disability insurance benefits, potentially reducing the private benefits but not eliminating them. C. Workers' compensation benefits and private disability benefits cannot be received at the same time under any circumstances. D. Workers' compensation benefits have no effect on the eligibility for private disability insurance benefits in Georgia. Answer: B. Workers' compensation benefits are coordinated with private disability insurance benefits, potentially reducing the private benefits but not eliminating them. Explanation: in Georgia, as in most states, workers' compensation benefits are coordinated with private disability insurance benefits. This means that if an individual is receiving workers' compensation benefits for a work-related injury, the amount of private disability insurance benefits they receive may be reduced. The goal is to prevent the individual from receiving more than 100% of their pre-disability income. However, workers' compensation benefits do not automatically eliminate private disability coverage altogether. Question 10. Which of the following is true regarding disability insurance benefits taxation? A. Disability insurance benefits paid under an employer-sponsored group policy are always tax-free. B. Benefits received from a private disability insurance policy that the insured paid for with after-tax dollars are tax-free. C. Disability insurance benefits paid under an individual policy are always subject to federal income tax, regardless of how premiums are paid. D. Benefits received from any disability insurance policy are always subject to state income tax, regardless of federal tax status. Answer: B. Benefits received from a private disability insurance policy that the insured paid for with after-tax dollars are tax-free. Explanation: disability insurance benefits are typically tax-free if the premiums were paid by the insured with after-tax dollars. If the premiums were paid by the employer or deducted from pre-tax income, the benefits may be subject to federal income tax. The taxability of benefits can vary depending on the source of the premiums and the tax status of the individual. Disability benefits are not always subject to state income tax, and state tax laws may vary. Question 11. Which of the following is most likely to be excluded under a disability insurance policy? A. Disability resulting from a work-related accident. B. Disability resulting from a self-inflicted injury. C. Disability resulting from an illness contracted while on vacation. D. Disability resulting from an accident during a recreational activity. Answer: B. Disability resulting from a self-inflicted injury. Explanation: self-inflicted injuries are typically excluded from coverage in most disability insurance policies. These types of injuries are considered preventable, and the insured would not be compensated for injuries that they intentionally caused. Other types of disability, such as those resulting from work-related accidents or illnesses contracted while on vacation, are usually covered depending on the specific terms and conditions of the policy. Question 12. Which of the following describes a situation where a policyholder is entitled to benefits under a long-term disability insurance policy? A. The policyholder has been unable to work for 60 days and meets the elimination period requirement. B. The policyholder has been unable to work for 120 days but has not yet reached the benefit period. C. The policyholder is able to work in a modified role but cannot perform their prior duties due to disability. D. The policyholder's disability is covered under workers' compensation and they are not entitled to additional benefits. Answer: A. The policyholder has been unable to work for 60 days and meets the elimination period requirement. Explanation: under long-term disability policy, the insured must first meet the elimination period, waiting period, before benefits begin. If the insured has been unable to work for the specified number of days, in this case 60 days, and the elimination period is satisfied, they may be eligible for benefits. If the disability is covered under workers' compensation, the LTD policy may reduce the benefit amount based on workers' compensation payments. The LTD benefit is designed to replace lost income after the elimination period and as long as the insured remains disabled. Question 13. Scenario-based. Mr. Thompson, an office worker in Georgia, has a disability insurance policy with a 90-day elimination period. He has been diagnosed with a chronic back condition and has been out of work for 70 days. Mr. Thompson submits a claim for his disability benefits. What is the most likely outcome? A. Mr. Thompson's claim will be denied because he has not completed the 90-day elimination period. B. Mr. Thompson's claim will be approved for the full benefit amount despite not completing the elimination period. C. Mr. Thompson will receive a partial benefit payment for the 70 days he has been out of work. D. Mr. Thompson's claim will be denied unless he provides documentation that his condition was caused by a workplace injury. Answer A. Mr. Thompson's claim will be denied because he has not completed the 90-day elimination period. Explanation. In this scenario, the key factor is the 90-day elimination period. Disability insurance policies typically require the insured to be disabled for a certain period, the elimination period, before benefits are paid. Since Mr. Thompson has only been out of work for 70 days, he has not yet met the 90-day elimination period requirement. As a result, his claim will likely be denied. The elimination period is essentially a waiting period before the insurer starts paying benefits. Question 14. Which of the following is true about the taxation of disability insurance benefits in Georgia? A. Disability benefits from a privately purchased policy are always subject to federal income tax. B. Disability benefits from a policy purchased with pre-tax dollars are subject to both federal and state income tax. C. Disability benefits from an employer-provided policy purchased with after-tax dollars are subject to state income tax. D. Disability benefits from all policies are exempt from both federal and state income tax. Answer. B. Disability benefits from a policy purchased with pre-tax dollars are subject to both federal and state income tax. Explanation. Disability benefits are generally taxed based on how the premiums were paid. If an individual purchases disability insurance through their employer and the premiums are paid with pre-tax dollars, the benefits received will be taxable. This includes both federal and state income taxes. If the policyholder pays premiums with after-tax dollars, the benefits are usually tax-free, though specific state laws may vary. The tax treatment of benefits depends on the payment method used for the premiums. Question 15. Which of the following provisions would most likely be included in a long-term disability insurance policy to prevent the overpayment of benefits? A. Benefit escalation clause. B. Coordination of benefits clause. C. Pre-existing conditions clause. D. Total disability clause. Answer. B. Coordination of benefits clause. Explanation. The Coordination of Benefits (COB) clause is designed to prevent overpayment when a policyholder has multiple sources of disability benefits, such as from a private disability insurance policy and Social Security Disability Insurance (STI). This clause ensures that the total amount of benefits the insured receives from all sources does not exceed 100% of their pre-disability income. The COB clause adjusts the private disability benefit to account for the SSDI or other benefits received. Question 16. How does Georgia's workers' compensation disability benefit typically interact with private disability insurance benefits? A. Workers' compensation disability benefits and private disability insurance benefits cannot be received simultaneously. B. Workers' compensation benefits are added to private disability insurance benefits, increasing the total benefits received. C. Private disability insurance benefits are reduced when workers' compensation benefits are received to avoid double dipping. D. Private disability insurance benefits pay out only if workers' compensation benefits are denied. Answer. C. Private disability insurance benefits are reduced when workers' compensation benefits are received to avoid double dipping. Explanation. In Georgia, as in many states, workers' compensation disability benefits and private disability insurance benefits are coordinated to avoid double dipping. When an individual is receiving workers' compensation, the private disability insurance benefits are often reduced or offset by the amount of workers' compensation they receive. This ensures that the individual does not receive more than 100% of their pre-disability income, which is a common feature in disability insurance policies. Question 17. Which of the following best describes the role of a future increase option rider in a disability insurance policy? A. It allows the insured to increase their benefits if they are unable to work due to a new disability. B. It allows the insured to increase their benefit amount without medical underwriting as their income increases. C. It allows the insurer to increase premiums based on the insured's age. D. It allows the insured to add additional coverage for family members who may become disabled. Answer. B. It allows the insured to increase their benefit amount without medical underwriting as their income increases. Explanation. The future increase option FIO rider is a feature that allows policyholders to increase their disability insurance benefits in the future without undergoing additional medical underwriting. This is often used when the insured's income increases over time, allowing them to adjust their coverage to match their income. The FIO rider is beneficial for individuals who anticipate growth in their income and want to maintain sufficient disability coverage. Question 18. Which of the following statements about pre-existing conditions is true with respect to disability insurance coverage? Disability insurance policies typically do not cover disabilities resulting from pre-existing conditions during the first 12 months of coverage. B. Pre-existing conditions are always covered after a policyholder has been insured for 6 months. C. Pre-existing conditions are never covered by disability insurance policies under any circumstances. D. Pre-existing conditions are always covered under state disability insurance programs, regardless of the private policy terms. Answer A. Disability insurance policies typically do not cover disabilities resulting from pre-existing conditions during the first 12 months of coverage. Explanation. Most disability insurance policies have a pre-existing condition clause that excludes coverage for disabilities resulting from conditions that existed prior to the policy's effective date. Typically, there is a waiting period, often 12 months, during which the insurer will not pay benefits for a disability that results from a pre-existing condition. This is designed to prevent individuals from purchasing insurance only after becoming aware of a medical issue that could lead to a disability. Question 19. Which of the following factors is considered when determining the premium for a disability insurance policy? A. The insured's income level. B. The insured's marital status. C. The insured's number of dependents. D. The insured's social security disability status. Answer A. The insured's income level. Explanation. The premium for a disability insurance policy is largely based on the insured's income level, as the amount of coverage purchased is typically tied to the insured's salary. Higher income levels generally result in higher premiums, as the policy is designed to replace a percentage of the insured's income in the event of a disability. Other factors such as marital status, number of dependents, and social security disability status may influence eligibility or benefit amounts, but income is the primary factor in determining the premium. Question 20. Which of the following provisions in a disability insurance policy helps to ensure that the benefits maintain purchasing power over time? A. Future increase option. B. Cost of living adjustment COLA rider. C. Elimination period. D. Residual disability benefit. Answer B. Cost of living adjustment COLA rider. Explanation. The cost of living adjustment COLA rider is designed to increase the benefit amount over time to account for inflation and the rising cost of living. This rider helps ensure that the insured's benefits maintain their purchasing power over the long term. Without this provision, the fixed monthly benefit amount may lose value over time due to inflation. The COLA rider is particularly important for long-term disability policies, which can last for several years or even until retirement. Question 21. What is the typical purpose of an own occupation definition in a disability insurance policy? A. It defines disability based on the inability to perform any occupation. B. It defines disability based on the inability to perform the specific job or occupation the insured was doing prior to the disability. C. It defines disability based on the inability to perform household duties. D. It requires the insured to prove they have lost income from their occupation. Answer B. It defines disability based on the inability to perform the specific job or occupation the insured was doing prior to the disability. Explanation. A own occupation definition of disability in a policy provides that the insured is considered disabled if they are unable to perform the specific duties of their occupation, even if they are able to perform other types of work. This is a more favorable definition for the insured than any occupation coverage, which would only pay benefits if the insured is unable to work at any occupation for which they are qualified. Question 22. Which of the following would likely be considered a residual disability under a disability insurance policy? A. The insured can no longer perform any work duties. B. The insured's income is reduced, but they can still work in a limited capacity. C. The insured's disability is not recognized by the insurance company. D. The insured suffers a permanent total disability. Answer B. The insured's income is reduced but they can still work in a limited capacity. Explanation. Residual disability refers to a situation where the insured can still perform some work duties, but their ability to do so is limited, causing a reduction in their income. In this case, the insured is partially disabled and may be entitled to a partial disability benefit to compensate for the income loss caused by the reduced ability to work. Question 23. Which of the following is typically NOT covered under a standard disability insurance policy? A. Disability caused by a severe injury from a car accident. B. Disability caused by a chronic illness like cancer. C. Disability caused by drug addiction or alcoholism. D. Disability caused by an accident occurring while on vacation. Answer. C. Disability caused by drug addiction or alcoholism. Explanation. Disabilities caused by drug addiction or alcoholism are generally excluded from coverage in most standard disability insurance policies. These conditions are often considered self-inflicted or preventable, and insurers may exclude them from coverage to limit their risk. Other conditions, such as injuries from accidents or chronic illnesses like cancer, are typically covered under most policies. Question 24. Which of the following best describes the elimination period of ECA disability insurance policy? A. The period after which the policyholder's benefits begin to decrease over time. B. The waiting period before the insured can start receiving benefits. C. The period during which the insured is required to pay higher premiums. D. The period during which the insured must be working before coverage kicks in. Answer. B. The waiting period before the insured can start receiving benefits. Explanation. The elimination period is a waiting period specified in the disability insurance policy before the insured is eligible to start receiving benefits. It is typically 30, 60, or 90 days. The purpose of this period is to prevent claims for short-term or minor disabilities and to reduce the insurer's administrative costs. Question 25. Scenario-based. Mr. Lane has a disability insurance policy with a 180-day elimination period. After a severe car accident, he is unable to return to work for 120 days. What is most likely the outcome of his claim? A. Mr. Lane will be approved for benefits because his accident occurred after the policy was issued. B. Mr. Lane's claim will be denied because he hasn't completed the elimination period. C. Mr. Lane will receive partial benefits for the 120 days he was out of work. D. Mr. Lane will be approved for benefits only if his condition is not related to the car accident. Answer. B. Mr. Lane's claim will be denied because he hasn't completed the elimination period. Explanation. Mr. Lane has not met the required 180-day elimination period before being eligible for benefits. Disability insurance policies typically specify that benefits begin only after the insured has completed the elimination period. Since he has only been out of work for 120 days, the claim would likely be denied until he completes the full 180 days required under the policy. Question 26. Which of the following is a potential disadvantage of a policy paid disability insurance premium? A. The insured will be taxed on the benefits they receive. B. The premiums are lower than those paid by employers. C. The policy cannot be cancelled by the insurance company. D. The premiums are tax deductible as a business expense. Answer A. The insured will be taxed on the benefits they receive. Explanation. If the premiums for a disability insurance policy are paid by the policyholder, i.e., policy paid, the benefits are typically received tax-free. However, in the case of policy-paid premiums, the insurer's policy is usually structured so that the insured would have to pay for the premiums personally and would not benefit from any tax deductions. Other policies where premiums are paid by employers may result in taxable benefits upon receipt. Question 27. Which of the following statements about long-term disability insurance policies is true? A. They typically cover disabilities that last less than 30 days. B. They usually provide benefits for a period of 1 year or more. C. They only cover disabilities caused by accidents. D. They pay benefits only for disabilities that prevent work in the policyholder's own occupation. Answer. B. They usually provide benefits for a period of 1 year or more. Explanation. Long-term disability insurance policies typically provide benefits for extended periods, often lasting 1 year or more, in contrast to short-term disability insurance, which provides benefits for a few weeks to a few months. Long-term disability policies are designed to help individuals who are unable to work for an extended period due to illness or injury. They usually pay a percentage of the insured's salary to replace lost income. Question 28. Which of the following factors does NOT typically influence the cost of disability insurance premiums? A. The insured's occupation. B. The insured's gender. C. The insured's age. D. The insured's political affiliation. Answer: D. The insured's political affiliation. Explanation: disability insurance premiums are typically influenced by factors such as the insured's occupation, age, and gender. Occupation plays a significant role because high-risk jobs are more likely to lead to disability. Age is important because older individuals are at a higher risk for injury and illness. Gender may influence premiums due to statistical differences in disability rates between men and women. Political affiliation, however, has no bearing on disability insurance premiums. Question 29. Which of the following types of disability insurance policies is typically designed for self-employed individuals? A. Group disability insurance. B. Social Security disability insurance. C. Individual disability insurance. D. Workers' compensation insurance. Answer: C. Individual disability insurance. Explanation: self-employed individuals are generally not eligible for group disability insurance or workers' compensation. Instead, they can purchase individual disability insurance policies that are specifically tailored to meet their needs. These policies are designed to replace a portion of income if the self-employed individual becomes disabled and cannot work. Question 30. Which of the following would be most likely to trigger the termination of disability benefits under a policy? A. The insured's income increases while they are disabled. B. The insured recovers and returns to work after a period of disability. C. The insured moves to a different state. D. The insured refuses to comply with medical treatment recommendations. Answer: D. The insured refuses to comply with medical treatment recommendations. Explanation: most disability insurance policies require the insured to follow medical advice and comply with treatment plans in order to continue receiving benefits. If the insured refuses to comply with medical treatment recommendations, the insurer may consider this as a failure to cooperate and may terminate the disability benefits. This ensures that the insured is actively working toward recovery and is not prolonging their disability unnecessarily.